Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of Chart This with Dave Keller. I'm your host, Dave Keller. Instead of coming to you from Redmond, Washington this week, coming to you from music camp for adults at the Walden School in Southwest New Hampshire. Good to be up here in a rainy New Hampshire, playing, singing, composing, arranging, experiencing, experimenting. A lot of great creative opportunities up here, and also fun to check in on the markets. This is sort of a different vibe for me, being in creative mode all day. But I tell you what, if there's something, one of the takeaways I have from this week, and I think probably next week once I get home, I'll share some of these overall takeaways. But one key one right off is there's a great benefit to not watching the flickering ticks every moment. I do a pretty good job of having a lot of scheduled interviews and things that kind of take me away from looking at the markets on any given moment. But I know for many of us, it is so easy, particularly on an important day, to just be kind of eyes glued to the screen. And one thing I'm learning, especially if your runway is long enough and if you have a longer time frame that you're thinking about, you don't really need to pay that close of attention moment to moment. You do need to have consistent processes and routines to evaluate conditions, to assess whether your portfolio is still, helping you be in the right place at the right time. But that doesn't mean you have to have your eyes glued to the screen. So one of the takeaways I have from this week for sure. All right, well, it'll be an adjusted show this week, but I appreciate you guys hanging in there. We're going to show this video live after the close, but I appreciate you putting questions in there. I do see the questions coming in as we're streaming. I won't be able to get to them live today, but I will capture all the good questions, put them in the mailbag. Friday, we'll do an all mailbag episode, and I would love to answer one of your questions there. Here's the bad news. The S&P selling off going into this week's Fed meeting today, certainly driven in part due to, continuingly concerning news out of the Middle East. Certainly appears that the U.S. may be drawn in some capacity, and that's certainly not being denied anywhere that I'm seeing, at least more recently. And the markets are starting to pull back as a result. S&P did close below 6,000. That's down 0.8% from yesterday's close. The NASDAQ composite down a little bit more, but not by much, 0.9%. Mid caps, small caps, all down about the same. So generally the market down just under 1% today. Look at the VIX. Yesterday, we had highlighted how the VIX moved back below kind of our red flag threshold of 20. Today, right back above there. So, for one day, we had a break from the excessive volatility or elevated volatility. And as I mentioned, the VIX is an important thing to watch. Not that I think, just watching the 20 level on the VIX is it. I think there's more to it. But I would say as a basic premise, right, it is fairly safe to assume that the market's probably not going to build some significant sell-off without the VIX pushing above 20, most likely moving above 25 and even 30. So until and unless that happens, there's just not much to be worried about. We're starting to see that happen here with the VIX back above 20 today. Certainly something to watch as we get through this week's Fed meeting. Bonds rallied today in a bit of a safe haven move. Stocks are down, bonds are up. You can see interest rates, of course, as bond prices are moving higher. That means yields are moving lower. That pushes the 10-year yield just below 4.4%. The long bond yield is below 4.9%. And the 5-year point back below 4% at the close. Check out the dollar. We highlighted on yesterday's show how the dollar had been rallying. We looked at the UUP together. Today, I will announce that the dollar continuing to push higher. Now, that's a bit of a concern. With the dollar rallying and with U.S. Treasury bonds rallying, that implies, at least in some limited capacity for now, that non-U.S. investors are converting to U.S. dollars and buying U.S. debt. It's not necessarily guaranteeing that that's exactly what's happening. It does imply that that's a general kind of flow of funds that we can infer based on a stronger dollar and stronger bond prices and weaker equity prices. Commodities generally doing pretty well today, although copper was down and gold was basically flat. But you have silver prices up over 2%. That's using the SLV. Crude oil prices accelerating to the upside, given additional stability and certainly heightened tensions in the Middle East. The USO was up almost 5% today. Natural gas prices up as well. And you'll find that the energy sector, the best performer. Bitcoin starting to look like a risk asset today. Yesterday, we saw Bitcoin rallying while equities were pushing a bit higher. But today, we see both of them rotating back to the downside. Bitcoin down 2.2%. It's just below 105,000. It's rallied a bit here in the last hour or two. You can see Ethereum price is slightly lower, and all 10 of the top coins tracked on the stock charts platform in the red today. Looking at the 11 S&P sectors, you can see energy, the only one that's up. And again, that's driven basically by the strength in crude oil prices. It's the big energy names that are really starting to participate. It's the oil producers, the integrated oil companies. They're the ones that are tied more to, the price of the underlying commodity, which is crude oil in this case. So crude oil, natural gas prices higher, the whole energy sector doing pretty well today. The XLE up 0.9%. Everything else was down today. REITs were number 2. Financials were number 3, but both of those were also down. On the downside, you have consumer discretionary down 1.7%. Tesla really feeling the pain here, putting in a bit of a lower high and rotating lower. Healthcare number 2 down 1.7%. Materials down about 1% today. Looking at the breadth, it was not good, particularly in the S&P 500. You can see 82% of the S&P stocks were down. Only 18% were up. About a 2-to-1 ratio of stocks down versus up on the New York Composite Index. So, and a 3-to-1 ratio on the mid-cap index. So very much a risk-off feel to the tape today, a risk-off feel in terms of the breadth conditions, risk-off feel in terms of the volume as well, as I'll show you in a minute. I have an update on the shaken money flow, which we highlighted yesterday. Looking even worse today. All of the Magnificent 7 stocks were down today. Microsoft, which is continuing to do quite well and outperform and pan out a pretty consistent pattern of higher highs and higher lows, down slightly, about 0.25%. That's from Microsoft. Netflix, also a decent chart, down about 0.4%. NVIDIA down 0.4% as well. Tesla, as I mentioned, the big laggard in this group, down 3.9%. The chart of Apple looking less and less good right now, down another 1.4%. Broadcom down slightly more than 1%. Looking briefly at the market carpet, which is a heat map style visualization. Again, not a lot of exciting big uptrend kind of names, but I would tell you on a day like today, when the breadth was pretty negative and the general benchmark moves were lower, there are plenty of things that were down today. And you can see it's concentrated in sectors like consumer discretionary, healthcare, really the 2 big sectors, maybe industrials number 3. Other than that, not too bad in terms of the percentage changes. Those are the 3 sectors with really some significant concentrations of down days for some of the S&P 500 names. But I would say what's really encouraging, or what's important, is to focus on names that were not down. If the benchmarks were down, if most stocks were down, which names were bucking the trend and actually had some positive moves? As I mentioned earlier, look at Valero, up 3% today, making a new 3-month high today. Marathon Petroleum Company, MPC, making a new 3-month high today. Exxon and Chevron, not quite making a new 3-month high, but getting there because they made some pretty major highs at the end of March, beginning of April. Pretty close, with some nice breakouts above recent swing highs. So that's really the strength. Other than that, it's random one-off names, like in communication services, Live Nation, very different. In healthcare, Humana, bouncing off of lows. In technology, CrowdStrike, making a new 52-week high today. Jabil, JBL, making a new 52-week high today, up almost 9% today. Palo Alto Networks, pushing above $200. Within the industrial sector, not surprisingly, defense and aerospace names like Raytheon, like Huntington, like Lockheed Martin, Northrop Grumman. These are all names that are at or near new 52-week highs, given the pressure in the Middle East and expectation that there's going to be greater focus on aerospace and defense around the world here. Hopefully not, but it certainly seems to be the trend that we're observing here. So again, on a day like today, I would focus my attention on the names that were up, that managed to have decent days. That means they did not follow the broader market trend lower. That means there's something going on there that you may want to check out. Speaking of things you may want to check out, by the way, just a quick announcement. Seeking Alpha is doing their summer sale, actually just kicked off at the end of last week. I put out a video on my YouTube channel called Market Misbehavior. You may be watching this video there. If you go to my YouTube channel, find my most recent full video, and it was highlighting some of the ways that I use the Seeking Alpha platform to create successful routines, to think about market conditions, to focus on how my portfolio is doing, and to generate ideas. I would encourage you to check out that video. And if you want to learn more about Seeking Alpha, now is a really good time to do it, because they're offering a really strong sale here in the summer. It's one of the few times of the year where they have a really strong sale for the premium platform. You can find out more about that at marketmisbehavior.com/Seeking Alpha. you'll get a special deal. You get a 7-day free trial. And also coming up very soon, they actually will do a second half of 2025 market outlook featuring Steve Kress, the head of the quantitative department there. Go to marketmisbehavior.com/seeking alpha for more information. Again, a special deal does not cost you anything more. Actually gets you a little better deal than if you just go to their website, and it helps me make Market Misbehavior awesome. All right, let's finish off looking at some charts here, and then we'll call it an early evening here in New Hampshire because I've got more singing and playing and concert attending to go here at Music Camp. All right, looking at the S&P daily chart, we highlighted at the end of the last week the bearish momentum divergences. Friday of last week, we had this pullback. Certainly looked, in my opinion, like we were confirming that bearish divergence. Yesterday, here's that update. Today, we're right back at a very similar move to what we saw on Friday. I think this is very much confirming a bearish momentum divergence, higher highs in price, lower peaks of momentum. That's a big red flag telling you that the bull market is most likely near an exhaustion point. Now what I think you need to do is start to look for confirmation. Look for confirmation that breadth conditions are continuing to deteriorate. Look for confirmation in the form of momentum breaking down. Look for the RSI to push below 50, maybe even 40 on a pullback. Look at lines in the sand and see if they hold on the chart of the S&P, also on key stocks like Microsoft and others that have been doing so well. The breadth is really starting to turn lower. Today, we saw less than 50% of stocks above their 200-day moving average. It's still only 49%, so it's not horrible. And it is right around that zero level. I think this is an important chart to watch. If this indicator would continue to go lower this week into next week, I think that would really validate the bearish divergences we've been observing. We're also finding that now less than 70% of S&P members remain above their 50-day moving average. That's down from about 80%. So 12% of the S&P have just in the last week broken down below their 50-day moving average. The lower that goes, the more I think that validates a significant pullback phase for stocks. The bullish percent index on the S&P 500 pushed back below 70%. It had gone back above at the beginning of this month. Moving back below is a sign of concern. The NASDAQ 100 bullish percent index, I think, is vital because these are the growth leadership names. And if they can remain strong, things just aren't getting that bad. But if they start to break, that could be a real dangerous situation. I would watch that to see if it breaks below 70%. And if so, I think that would be a big check mark in the bearish column. We highlighted this chart yesterday with the divergence between price and the Chaikin money flow, suggesting that the trend in volume has been more negative. Today, after yesterday's pullback, today even more. So we're seeing weakening volume or additional signs of distribution this week. We highlighted the VIX moving back above 20. I think that's a significant red flag as well. As long as it remains above there, and if it keeps going higher, I think that's a dangerous sign. Yesterday, we highlighted a bullish momentum divergence with the US dollar. Today, the dollar bouncing higher. One of the biggest up days we've seen in the last couple of months. I think further strength in the dollar paired with strength in bond prices would imply non-US investors going into US Treasury debt as a big time defensive play. Bitcoin pulling back, traded below its 50-day moving average today, currently trading just above that, just below 105,000. This has held the last couple attempts in June. We'll see if that continues. Crude oil, the big story here. The reason why energy is up today while everything else is down is because crude oil prices are spiking in reaction and in anticipation of further upheaval in the Middle East. And I think that's, we've been waiting for signs of a bullish trend in crude oil prices. I think now we have completely gotten them. We gapped above the 200-day. We're holding that. Crude oil is in an uptrend until further notice, in my opinion. Apple's just not a great chart. It's not a horrible chart. And I will tell you, we're very close to differentiating an okay chart, which I think it is, to a really horrible chart. Now, we are below 2 downward sloping moving averages. That's not good, but we're holding the May low. So I think if I were, looking at this and looking for a sign of a confirmed bearish trend, I'd be setting an alert for 192, 193. I think if Apple breaks below there, that confirms a new downtrend phase and an exit from this consolidation phase. Also look to see if the RSI breaks below 40. But regardless of what you think about Apple, the relative strength over the last 4 months has been a disaster. That's why I avoid charts like that, because of the weaker relative strength. Tells you there are better opportunities elsewhere. We'll finish off with CrowdStrike. Friendly reminder, regardless of what you think about the market environment, I sign off every show with it's always a good time to own good charts. And that means charts like CrowdStrike, Charts like Microsoft, charts in uptrends of higher highs and higher lows. In my opinion, just because the trend in the market starts to change does not mean that you just blindly sell charts that are still very good. It is indeed always a good time to own good charts. Folks, that'll do it for an abbreviated episode. Thank you so much for bearing with me this week and being patient as I go and scratch a creative itch that's in my brain that I rarely get to enjoy. And I'm having an absolute blast. A pleasure to take a break here from singing, playing trumpet, writing music, doing electronic music, all sorts of stuff, to share some market observations with you. Keep your questions coming either during the live stream or just put them in the comments section of our YouTube channel. We'll be checking those questions out. Hope to answer one of yours in our next mailbag episode on Friday. That'll do it for today. I'm Dave Keller with Market Misbehavior, reminding you it's always a good time to own good charts. Have a good night, folks.